As you move into retirement, the planning gets more complex. Now you have to replace the income that you were earning when you were working. And the question becomes, do you know how to maximize that income while minimizing your tax exposure? In this video, I will share with you some of the retirement income planning strategies that will help you to do just that. Hi, my name is Mark Singer, and for more information and timely information on retirement income, Social Security, click on the link below to subscribe to our channel and hit the notifications bell to learn when we post new videos. So I'm going to share with you some of these retirement income planning strategies that present themselves for those who are in their 60s, and also identify some strategies for those who are in their 70s and beyond the required minimum distribution, because in the new pandemic here and new legislation, you need to be aware of some of the new strategies available that may only be available for this year. But I want to start first and foremost with conversation that I have a lot with clients and people that I talk to about retirement and retirement planning, which is the difference between the accumulation stage and the distribution stage. In the accumulation stage, you wanted to manage your money in such a way that it grew to a point where you had that nest egg. You could then go about and retire. To move into retirement and now into this distribution phase, where the key is more about generating as much income as you need and minimizing the taxes more so than just growing your portfolio. So we have to keep that in mind, because you need to make a sort of a calibrate a little bit differently upstairs how you look at your portfolio and how you look at the planning now that you are retired or about to be. So let's start off with Social Security, because that's a big one, right? I mean, I've done probably a couple of dozen Social Security videos that you can see on the site, but I don't want to talk about the 567 different strategies at this point. You can go view those videos. What I do want to talk about, though, is the impact of taxation, okay? And if I take you to my screen right now, what I want to share with you is the impact, and more so the understanding, of provisional income. And the provisional income is what you need to be aware of when it comes to Social Security, where you could pay upwards of 85% of your Social Security benefit could be taxed. And the way to understand the provisional income is your adjusted gross income, your AGI, plus 1/2 of your Social Security benefit, plus any tax-exempt interest, typically municipal bond income. So if you're over $44,000 for provisional income and you're married, up to 85% of that amount is going to be taxed. And if you're single, that number goes up to only $34,000. So you have to not only decide when the best time to take Social Security would be, and I'm a big advocate on first understanding the planning to understand when the optimal time to take it. Again, there's 567 different strategies. For the most part, you're better off not taking it early in the penalty phase, I call it, but taking it at least at full retirement age, if not until age 70. But what happens if you're still working and you're before your full retirement age and decide to take Social Security? So if you'll notice here that if you apply for Social Security before full retirement age and you're working, $1 in benefits will be withheld for every $2 you earn over $18,240 in the year 2020. The benefit will be at full retirement age. In other words, you'll start to get some pieces back as you get to full retirement age and beyond. So a big planning tenet is, with regards to Social Security, how to maximize it for your family, but more so, how do you keep more of it that you are supposed to receive than your benefit is? So make sure that when you not only decide when you want to take Social Security, but when the optimal time is not just to maximize the income, but to minimize the taxes. The second strategy is the potential of a Roth conversion. And this conversation goes on a lot as well. And I must tell you, sort of like giving you the butler did it at the end of the book before you read the whole book. It's not a strategy that I would recommend for many to initiate it when they retire. It's much better when you've done it much earlier. So the deal is you can convert your IRA to a Roth. And let's say you have $100,000 in your IRA and you want to convert it to the Roth, you can do that. But you're going to pay somewhere in the vicinity, depending upon your tax bracket, of, let's call it $25,000. So that's a big chunk to pay. And if you don't have the liquidity on hand to pay the $25,000, you may have to take the $25,000 out of the IRA to pay it, which would be additional taxes you would owe. And then it would take some time to break even before you would actually see a benefit of having made that conversion if you wait till your retirement. So Roth conversions are great because or I should say Roths are great because monies taken out are no longer taxable, unlike the regular IRAs. But to convert it into a Roth, you're much better off if you're seriously considering retirement and carving out a piece to go into your Roth, probably no later than your early 50s, if not before then. I will say, however, it's a great tool for your kids or for legacy planning, the Roth conversion. We did a whole video on this if you want to take a look at that. If you have an estate that is large enough that you can carve out a piece and it's okay to pay the tax on a piece of your retirement, that would then be earmarked to take care of the kids or grandkids at a later point in time, then the Roth conversion makes a lot of sense. But typically, the Roth conversion at about the time you're retiring is really something you should have thought about beforehand. You can crunch the numbers, but typically it's not a great idea at this moment. Now, I know that there's a lot of different strategies in terms of maximizing income and minimizing taxes. And if you have an interest in learning more, make sure that you click the link to take a look at our masterclass to help you avoid some of the 4 common mistakes some people make. So finally, and this is really important for those who are in their 60s versus those who are in their 70s, or more specifically over the age of 72. So let's start in the 60s. Let's assume you've done the planning, big assumption, but let's assume you've done the planning, and you've recognized you need, let's call it $35,000 from your portfolio in terms of ongoing annual income in order to pursue your retirement goals. Okay, so you need $35,000. Let's assume you have $1 million in the portfolio. Let's say $500,000 is in the retirement or IRA and $500,000 is in the personal or taxable account. If you take the money out of the personal or taxable account, if it's done properly, you will more often pay less in taxes from taking it out of there. Let's assume it's coming out of qualified dividends. Then it's a tax rate of only 15%. So if you've taken $35,000 out, then your tax would only be about $5,200. So if you took it out of the IRA, however, and you took $35,000 out of the IRA, that would be fully taxed at your marginal tax bracket. Let's assume your marginal tax bracket is 20%. 20% on $35,000 is $7,000. That's an extra $1,800 each and every year if you had taken the money out of your IRA versus taking it out of your taxable account. Now, sometimes you don't have a choice to make, because for many, their largest asset is the 401k, which turned into the traditional IRA rollover. But if you do have the opportunity to be a little bit creative while you're in your 60s, typically, not always, but typically, you're better off to take it out of the taxable versus the IRA. Now, for those who are 72 or over, the planning is a little bit different because now we are faced with required minimum distributions. Now, that date used to be when we reached age 70 and a half. Now it's age 72. That was as a part of the Secure Act from last year. But as a result of the pandemic and some relief that has been made available, you no longer have to take the money out this year for your required minimum distribution. That's just this year so far, okay? So for many of my clients who don't really need or want the money out of the IRA, but are forced to take the money out at age 72 at a rate of about 3.5% in the first year, then you don't have to do it this year if you don't want to. Now, let me share with you the conversation I had with a client that could be, helpful to you to understand this a little bit more. Now, they have about, let's call it $500,000 in the IRA and another $200,000 or $300,000 in a personal or trust account. So we were administering required minimum distributions because now they're in their mid-70s, as well as income from their trust account. But when the legislation came out, we gave them a call and we said, listen, what do you really need for income? We know we're forcing this out on the IRA. Really need that full amount? And the answer was no. They could sort of back off by about $1,000 a month, which was important. So not only for this year did we reduce the amount they were going to receive by $1,000 because we could, we also shifted some of that distribution to the taxable account versus the IRA to save them in taxes. It's just one of those small strategies that is available. This one just for this year, we think. We never know what happens next year, but in paying attention to some of those details, you could save yourself as little as $1,000 or $2,000 in taxes, or if your income need is more, you could be saving yourself a lot more, or tens of thousands of dollars, depending upon what your need is. So that's what planning is all about. And again, if you're interested more about how to maximize your income, minimize your taxes, certainly you can click on the link below and take a look at our masterclass. I hope this has been informative for you. If it has, send it to a friend. Hit the subscribe button. Make sure you hit the notification bell. Thank you very much for watching, and I do truly hope you enjoy the retirement journey.